we're going to go ahead and turn the time right over to Kyprianos Kyprianou. This is actually part 2 of a presentation that he started a couple of weeks ago, and we're really excited to have him back. And we'll turn the time now over to you, Kyprianou.
Thank you very much. Well, actually, it is a part 2, but I will start with a small revision from the previous one. And if you need a little bit more information, you can go to the YouTube channel and you can find it and just follow it a little bit. So the first thing that we have to cover again, it's the definition of the trend. So a trend is a series of successive tops and bottoms, and we need at least 2 to decide that we have a trend. So of course everybody knows what is the benefit to trade in the direction of the trend, but actually one of the most important ones is that that is going to continue forever. Yeah, quotation marks, of course, right? Until we are going to have definite signals that the market will reverse. So in this case, as you can see, we have A, B, C, D, E tops, right? So the time that the market is going up to this top and then is reversing is actually going to a correction, and then it's breaking again the level A, and then it's going to the B, and then again another correction. The time that's breaking the B from this point and above, then we say that we are in an uptrend. So on the C, when it's going to be the time that we are arriving again to the C after the correction, so we know now that this potential or possible resistance will be broken with a big, wide, healthy candlestick. So, and then this is going to continue forever until we will have the failure of going higher. So the F, as we can see clearly here, is lower than the E. So at this point, we believe that the market will stop going higher because cannot even reach the E, not to break it. So that means on the reversal downwards, that is breaking a bottom, the market is breaking here a bottom for first time during this movement. So we say that we have the failure swing. So then immediately we define the E as the all-time high. With the same way, the market is going down, and below the second bottom, we establish a trend, and then it's going all the way down until we will fail to go lower than the lower bottom, the lowest bottom, which is the all-time low. So the time that we break for first time a top, then we have this failing to go lower and swinging up. That's why we call this formation failure swing. Of course, this is a failure swing to go higher, and this is a failure swing to go lower. And since this is happening after an uptrend, then this is the reversal to the downtrend, and this is the reversal to the uptrend. So actually, this is the basic datum for this system that I will deliver today. It's going to be a complete system that's going to help us to decide when exactly we are going to trade, and we are going to press the enter to buy and sell. So in this case, like the city group here, so we see that the market failed to go higher, breaking down. Below this level, we have a clear downtrend, and is the starting point of a downtrend. The opposite, so when we have this failing to go lower, so of course we don't have the chart for the downtrend, but let's say that we are here at the bottom, so and at the point above this top, then we have the failure swing, and above the second top, then we have the uptrend that is going all the way up to this top. This is the euro upward that went up to 160. So if we want to see the smaller picture, so this is the failure swing. That's the top that fails to go higher and breaking downwards. Swinging downwards, that means that we have the reversal of the trend. So if you can see it, and for those that know what we are talking about, so this is head and shoulder actually, but we are using only the right part to define the failure swing. So now, the thing is that most of the traders, they are looking for a trend in a bigger time frame than the normal. So from Dow theory, we know that when we are using the monthly candlesticks, so then we are using a bigger time frame, and we want to see the bigger picture. So if I show you a chart through the MetaStock, so we can see that some traders are using okay, so let's see. As you can see here, you can change easily the time frame from daily to weekly to monthly. So, and if we are checking the euro, then if we are using the monthly, let's say, then we go back as much as we want just to check what is going on, right? So if we are using the weekly, then, as Dow said, we are using only 6 months. That means from here we go back 6 months, and then we are checking if we have an uptrend or a downtrend. Look at what is a mistake that you can easily commit. So you can see all this picture, and then let's say here we had an uptrend, here we had a kind of a downtrend, then an uptrend again. So and then we have really a lot of trends. This is not correct to use all this time frame. So if we are on the daily, and this was happening on the media, they are showing the daily, and then they show actually all this, or maybe a little bit less, but they show all this part. So, and this is really very basic if you want to know what kind of trend do we have. So that's why allow me to show you again what Dow said about the time frames. So if we are using, let's say, the daily, that means every candlestick is 1 day. And again, allow me to show you again. So every day, every candlestick here is 1 day. So this is what's happening now. I think you can see that it's moving. Right? So normally we ignore the current day because it's not closed yet. So, and then we go back 4 weeks. So by this way, we limited the time frame for 1 month, maximum 4 weeks. So this is what Dow said. Every candlestick is 1 day, and we are using the daily candles, and we go back only 4 weeks. If we are using the weekly candles, then we go back just 6 months. And if we are using the monthly, then we go from the beginning of the last trend. Or in this case that we have the euro, actually is in a kind of a range. Let me show you again. Very easily, you change this one into weekly, and you change this one into monthly if you want. So, and then you can check the trend. As you can see, if there is no top and bottom in one direction, I mean a lot of tops and bottoms in one direction, then we consider this one as a rangey. Of course, it's a monthly time frame. That's why you see from 150 almost to 120 as a kind of a range. So if you want to see now the weekly, the periods that you are using, actually the time frame should be limited, should be only 6 months. That means this month, 2, 3, 4, 5, 6 from here. As you can see here clearly, there is no trend. So, and as we mentioned in the previous session, so to have a trend, we have to have a correction. So a correction, as we defined in the previous time, has to be a movement in the opposite direction of the general direction that is gonna create panic. As you can see here, using only the 6 months, the movement is just one up to there, and then all the way down, which is nothing. So if we are using the daily, I mean according to the trend definition, if we are using the daily, we have to use from 27 to 27 1 month. So this one, it is a kind of a downtrend, but it's not a clear thing, right? So allow me to show you some other instruments that maybe can have a better picture. from the trend point of view. Okay, so here is on the hourly time frame. So let's go for the daily, and this is a sterling. So when we go on the weekly, so as you can see, if you see the whole picture, the thing is a little bit confusing. If we are using only the 6 months, then maybe we can see something that is more clear for the direction of the market. So 1, 2, 3, 4, 5, 6 months starting from here. So as you can see, it's going up and then all the way down, still here. So still we cannot define a trend. So, and if we go on the daily, again, you have to use only 1 month. So that means if you go a little bit more, if you play with the plus and minus, then the MetaStock automatically throws the weeks. So 1, 2, 3, 4 weeks. As you can see here, still we cannot say that we have any kind of trend. If we go now for the hourly, then we are using 3 days only. So in here we can use 1 to 3 days, and then we can see that we have the second, we have one movement down, bouncing up, lower bottom, top here, which is lower than the previous one, and then is breaking down. So in this case, we can say that sterling is in a downtrend. So again, I don't think that anybody from us is checking the monthly chart just to take a position, but let's say that we start from the weekly, use the weekly candles and go back 6 months. So for the daily, use the daily candles and go back for 4 weeks only. For the currencies, if we are using the hourly candles, then we go back just for 3 days. For international stocks that we have futures for 24 hours, then we are using the hourly candlesticks and we go back for 5 days. For the local markets that they have only 3-4 days, so 3-4 hours trading, then we are using the 30 minutes candles and we go again back for 5 days. So this is according to our system. So, and then if you take this, try it for a while for your trading, and then maybe you can see clearer picture about the trends. So I'm gonna continue using the correct time frame, using the weekly, daily, and hourly, just to give you some examples how we can justify a position going in the direction of the trend. So, and always we are using some oscillators just to help us to spot the tops and the bottoms of the market. So in this case, I will cover one of the oscillators that we are using in our system, and is well known because it's called momentum oscillator. So, but normally, and the correct name of this is price rock, which means rate of change. Price rate of change. It was created by Martin Prink, and actually later on was named on the softwares as a momentum oscillator. So what is a momentum oscillator? Is actually a line that is going above and below a 0 line or a 50% line, so, and shows the strength of the market. So going to the price rate of change, excuse me, we can see here that we have the prices, and as soon as we create the oscillator, we use a new chart that we put the dots of the oscillator. So let's suppose that we are creating the ROC 7, so which is actually the rate of change for the last 7 days. So we have 1, 2, 3, 4, 5, 6, 7 days. So in the 7th day, we make a calculation, very simple. We are using the close of this day, and we deduct the close 6 days ago. That means this is the 7th day. We go back 1, 2, 3, 4, 5, 6 days. So, and then we make this calculation and we say 50 minus 30. So then we have a result 20. So, and then the next day, again, we are using this dot, the 50, and we go back 6 days again. 1, 2, 3, 4, 5, 6. That means, as you can see here now, I'm using this close with this close with 50 minus 20, and the result is 30. We continue like this, and then we have 60 minus 10, and we come up with 50, and we put a dot here. So we join the dots, and we create this oscillator that is called price rock. And then we put it with the prices. So we have the prices, and we have this blue line, so that is going up and down. So and then we follow. Actually, we compare what's happening with the strength of the oscillator that shows actually the strength of the market and the market itself. So in this case, allow me to go for an example here on the MetaStock that I think that you can do it very easily. So we can use, let's say, the sterling, and then we take from the list of the oscillators. So the price rock, you see, is in alphabetical order. We go down to the P, and then we go for the price rock. We take the price rock, and then we put it here. So, and now we have our oscillator with the prices, right? So, in this case now, there is a zero line because it's a subtraction in this case. So, and those are the values. But the important thing that we want to see, so, is the direction of the oscillator. So, in this, always try to use the 7 for this small and very fast trading system that I'm gonna show you today. So, I'm gonna make the zero line. I'm gonna make it black. So, and also you can change the parameters from here, and the color of the oscillator can be changed easily into blue or whatever the color that you want. All right. So now this oscillator now shows that when the prices are going down in a downtrend, this oscillator actually follows the trend of the prices, and it's very easy to understand that if we have a bottom here, and a bottom lower, normally has to coincide with the major bottoms of the oscillator. So in this case, as you can see, the bottom here, that was 150, 130, and the bottom of the price is, the new bottom of the price, that is 159.90. So it's not in the same direction with the bottoms of the oscillator. So in this case, we have the divergences. So what is a divergence? Actually, is when the prices are still going lower in this case, and the oscillator still is approximately at the same level, which is minus 40, as you can see here. So we will see right after how we will use this information about the negative divergence or the positive divergence, but I'm going to give it to you this on a small chart. So on a small drawing, just to see it a little bit better. So the negative divergence is when the prices are still going higher and the oscillator fails to go higher and continue this uptrend. So actually can show clearly that we go higher without strength, without power. So we can see this kind of divergences in many oscillators. But allow me to cover it only on this one. So on the price rock, and we have a positive divergence when the prices are still going lower and the oscillator fails to confirm this powerful movement down. Actually, we go lower without selling power. So in this case, that we have it on the Australian dollar, you can see that the Australian dollar continues going higher and the oscillator fails to confirm it. So in this case, we have a negative divergence. So we can see this on Apple, that we have consecutive higher highs, but the oscillator fails to confirm it. So the problem with the divergences is that we can continue going higher and still having divergences. So that's why during my trading and trying to solve this problem, I was looking for something that is a little bit more accurate, or at least that's going to tell me where approximately will be the top of this market. Because I can have a small correction here, I continue higher, and the oscillator can continue forever giving me divergences. I don't know if you face this problem during your trading, daily trading, but look at what is a real example, or what do I discover through all those years that I trade? It's actually using the same oscillator, which is the rock. I discovered that when we are approaching the top of the market, the oscillator maybe shows again a top of the actually is reaching the limits of the oscillator. So look at this. It's not like the other oscillators that you know. So we have a zero line, and we don't have anything that is gonna limit the oscillator except its own limits. So I don't know if it's clear to see on this picture what is going on here. So every instrument has its own limits. Using the price rock, we can see that we have three lines. We have the over extreme lines, that is actually the time that the oscillator is reaching its own over extremes. And then we have another line that we put it on the average extremes. And we have another line that is lower extremes, right? So in this case, I will cover the average extremes. Look at now how can I see the average extremes on the rock. So using the sterling. So I go now to see the history of this instrument. I can see that we have an over extreme here. I can see that I have average extremes that they are about this point, 0.5, 0.4. And we have another extremes that they are a little bit higher, right? So look at this now. I'm going to draw a line that's going to be at the average extremes, because this is the logic behind the extremes of the rock. So, and then I'm going to put the average extremes at the top. Look at how easy it is. I start going down and just stop there that you think that is the average line, right? And then you can compare what is happening at this extreme. So the price is moved up. At this extreme of the rock, prices bounce a little bit up. And then at these extremes, why not to see the oscillator going higher, right? And then we can go, let's say, at the tops, we can see that, let me use this line. Look at what's happening at this top of the oscillator. So at this top of, when the oscillator actually is stopping around the extreme line, actually the average extreme line, so then I have a top on the prices. When, again, at this point, the oscillator is topping, then the prices are topping. Here, as you can see, it's a little bit kind of a rangy thing. Again, I can see here that at the oscillator, the topping of the oscillator, the topping of the prices. Here at the over extreme we stopped a little bit and then come again to the zero and then extreme again. And you can try it on your instruments and check the extreme line. Actually, this is a way how to draw the average extreme line, right? For the tops and the bottoms. So this is telling that you know that it's a little bit choppy. So, but you can use it in any other instrument, and then use this line, the horizontal line, and move it up to the extreme of the oscillator, the average extremes of the oscillator. So, and then for the average extremes of the bottoms of the oscillator, and then you have there your lines. So when this is happening, we are expecting that's going to be at least a bounce up on the prices. So you can check it in any time frame. This is the hourly. You can check it on the daily also. Of course, it's going to be a different level, but still you can use your line and you put it at the average tops of the oscillator and the average bottoms of the oscillator, and then check what's happening with the prices. So again, I'm going to use a line. I'm waiting just to make sure that you see it also. So you see here, actually the oscillator was topping, and still the prices continue a little bit higher, then collapse. So here we had it once, here, second time there, third time there. I will cover this a little bit later. So here we had a top. It's not 100%, actually. Don't expect to find anything that's going to be 100% on this business. And during my 20 years experience, I know that there is nothing that's working forever. So, but still, I'm just giving you this simple oscillator to check and see that almost whenever we have, almost every time that we have a top on the oscillator, we have top, all right, on the prices. And now we are at this point. This is a daily time frame, right? So if you want to go now to the correct time frame, that's 4 weeks, you do it like this. So, and then you check if now we are at the average extremes of the oscillator. Okay, so this is now the two separate parts of this presentation. So we have actually the prices with the trends. So this is a trend, this is a downtrend, okay? And we are talking about the top of the market, and then right after we have a failure swing. So then we have a downtrend, the all-time low, and then we have a failure swing to go in an uptrend. So then I cover the oscillator, the correct time, in the correct time frame, of course. So, and then we cover the oscillator with the divergences. So, and the extremes of the oscillator. So as you can see here, now we have the euro, and if we are using this average extreme line, so if we check here, top of the oscillator, let me maximize it, top of the oscillator, top of the prices. So top of the oscillator, top of the prices. Top of the oscillator, top of the prices. This is the euro weekly. So, and then we have here top of the oscillator, but still went a little bit higher. So one missing. So then top of the oscillator, top of the prices. So then if you continue like this, so actually during this time frame, this period of time actually, when you are using the average extreme, so we have maybe 80 to 90% accuracy of the tops and the bottoms of the market. If we are using though the over extremes, which is actually this top, and this top, then it's 100%. So if we are using the green line, the statistics are a little bit worse, right? So, but now what I'm trying to show you is that if we are using the average extreme line, most of the times when the rock is touching this average extreme line, then most probably we have a top of the market. So, and is leading to a correction or even to a failure swing like here, like here, like here, and so on, right? So, of course, if you check the bottom, it's going to be the same thing. So, now, look at now a kind of a complete let's say, system. What do I recommend? Right? Is to use this information that I just gave you and have a strategy when exactly you are going to go long or you are going to go short, right? So for this case, I'm going to use the long position. So first we check the direction of the market. Then I check if we have a trend in our time frame. And I'm using the rock that is extreme below zero. And also if the rock has positive divergences. In this case, if I'm checking the 60-minute chart, then I go on the 10-minute chart and I'm using the first failure swing and I buy 50% of my money long. I go long actually on the lower time frame. So then I go for the B position, which is the failure swing on my time frame. Let's go again to our example so that we had before with the sterling. Right? This is not a recommendation again. I'm telling you that we just use this methodology in our system, and I'm using it for the last 15 years at least. So, and let's delete these lines. So, again, let's put the average line for the sterling on the hourly. So, and then the average line to the tops. And you have them there, right? So you don't move it. Okay, so now as we can see, the sterling reached the average extreme line. So in this downtrend movement. So this is my correct time frame, as I said. For the hourly, we are using only 3 days, and then I check and I have the downtrend. So I see that I have the extreme lines before it's going to touch the zero. So, and then what is my strategy? I go, this is the 10-minute chart. So, and then I'm checking the movement that is down. So then fail to go lower here, and then it's breaking up. So that means somewhere here, you can go long, but only with 50% of your money, right? You put your stop loss somewhere here, and then you are waiting to see what's going to happen. So what is the benefit and actually the advantage of this system? So if you are using the hourly time frame, that means you are using every candlestick 1 hour, and you have here the 10 minutes. And as soon as you see that the rock is reaching the extremes, and especially after of a couple of divergences, then you are expecting that sterling will go up. Normally, after this downtrend, you are expecting a failure swing to go long, right? But what I'm saying now, you can go long somewhere here, which is the 10 minutes failure swing. So by this way, we go a little bit faster in the market, but because we still don't have any reversal on the normal time frame that we have, so that's why I recommend to take a 50% position than 100%. So in this case, if you are wrong, then you are going to hit a stop loss on the 50% of your money. So, and then if the market is going to continue high and it's going to create a failure swing somewhere here, so the first position actually is covering you. So, and then you go for another 50% on the failure swing on the hourly. So I don't know if it's that clear, but I'm doing this for many years, and trust me, this is the best way to enter a position. And again, if I show you the drawing, just once more. So if my time frame is 60 minutes, then I go on the 10 minutes and I buy the first failure swing on the 10 minutes. What is a failure swing again? A downward movement, and then a bottom that is not gonna go lower beyond this last bottom. So, and then it's breaking up. At this break, you initiate actually the first position that's going to be 50%. So then, if on the hourly we'll have a failure swing higher, that's going to break high to go higher. So then you buy another 50% here and you complete your position. So why in two parts again? Because if you are wrong and the market is going to go down, you are going to hit a stop loss on the 50% of your money. You don't initiate a more position. Of course, if it's going to be the failure swing somewhere here, so and then it's going to come down again to break the all-time low, of course, you have a position already at very close to the low. So that's why you close this position and you go break even on the other one. And then again, you diminish the losses from the stop losses. What is the check that you have to do again is that you have a downtrend. Then the rock is at the extremes below zero. And also positive divergences. So in this case, expect the next failure swing on the lower time frame. So now let's suppose that the daily is your time frame. As I mentioned before, you go back for 4 weeks and you see that you have, let's say, a downtrend. So where exactly you are going to go long in this case? If you have the rock at the extremes below zero and the rock with the positive divergences, I mean the rock actually cannot follow this downtrend, and then you see the rock going at the extremes, wait on the 60 minutes, the failure swing to go up, and then add another 50%, take the 50% position here, and then add more when you have the failure swing on your time frame. So this is a way that I believe that is safer for you, and I'm using this methodology for the last 15 years at least. So, of course, if you have questions, you can type it. So in this case, the only thing that remains to complete the whole thing is the position size. It's actually the correct money management. So from my experience, so I know that we have people that they have, let's say, if they are working for a bank, so that they have already a credit amount that they can go long or short. So, and some other guys, so that they have only a small amount, but they can margin it up to the million, right? So I'm gonna go through this first, and then if there are any needs, I can go for the correct money management on the for the other example. So look at this. Let's buy. Of course, this is very basic. So we buy, let's say, 1 million euro. So at the price of 120, and we have to pay $1,200,000. So if the movement is in our direction and the prices are going higher, then the next day or the next hour, whatever, so you can go and give back your 1 million euro and you are going to receive $1,210,000. So this is the $10,000 that represents actually 1 cent difference, that we call it 100 pips. So if you buy only 1 million, right? So if you buy 1 million and you are making 100 pips or 1 cent, then the real amount of money that you are making is $10,000. So if you put a stop loss 35 pips, that I recommend it to be standard using the system. So if I want to hit my 35 pips stop, means that I'm going to gain back, if I have the 1 million, so I'm going to give it back and I'm going to take $1,196,500. That means I'm losing $3,500. So which is the risk reward ratio is pretty much good, because if you risk $3,500 to make $10,000, so I think it's logical. All right. So again, so we buy €1 and we pay $1,200,000. If I make 1 cent or 100 pips, I'm going to make $10,000. But if I'm going to hit my stop loss, then I'm going to lose $3,500. Right? So look at now some calculations. So if we have real money, $10,000, right, and we take margin. So let's say we have the real amount 10,000 and we margin it 50 times, right? So you can go for $500,000 trade, right? So your stop loss is 35 pips and your potential profit is 100 pips. So in this case, if you margin it 50 times, so then if you are going to hit a stop loss 35 pips, it's going to be $1,750, which represents 18% of your real money. So I think this is not that logical, because actually with 5 losing trades you can destroy your account. So that's why what we recommend, if you using, let's say, $10,000, it's better to margin it, let's say, maximum 30 times. So that means you go with 300,000. So, and if you have a stop loss 35 pips, it's going to be $1,000, which represents almost 11% of your money. So your potential profits will be 100. So you are making $3,000, and these $3,000 represent in your money, I mean, comparing with your money, 30% profit, which is really very good. So what do I say now? And if I put everything together, so we can have a position again, this is not a recommendation again. Templates. Okay. So I'm going to give it to you now, the same thing, which is sterling again. I'm going to make it hourly. I have my price rock. I have a couple of lines here. That is not the time to discover them. So this is it. So I put my horizontal line, and I can discover again that this was the lowest. The correct time frame is 3 days. It is in a downtrend, and the rock reached actually the average extreme after 2 divergences. So in this case, just change this one into 10 minutes and wait for the failure swing, which is actually, you see this one went down, failed to go lower, and broke with this one. Actually, we buy 151, whatever, 16.15, and we put a stop loss 35 pips below this entry point, and we are waiting to see what's going to happen. So if the prices will go higher, so then immediately you switch into the hourly and wait there for the next failure swing to add more position. Now, how much you're going to buy depends. If you have $10,000, as I said, your entry point should be 300,000. But on the 10 minutes should be only 50% of the 300,000, right? So now if you decide to margin it for 50 times, and you go for 500 still, so when you're going to buy at the failure swing or the lower time frame, so you buy $250,000, right? Why? Because if you're wrong and the market is going to go down, then you're going to hit 50% of your stop loss. That is saving you actually. But if it's going to go in your direction and the sterling will go up on the hourly, most probably after 2-3 hours it's going to create a failure swing here, and then it's going to go higher. So you buy more here. You initiate a position on the lower time frame, which is the 10 minutes in this case. So, and then wait to see if on the hourly will create a failure swing. So, and then you initiate the rest of your position. But if you are going to hit a stop loss, so then the loss is going to be a little bit less. It's going to be half actually, right? So this is the complete system that I promised. So in less than 1 hour. So, and then we will go for some examples. If you want to ask us something, you can type it or you can talk to us. So now, if we have this case now, let's go for another instrument. Let's go for the yen. Or maybe the euro yen. Let me check. Let's check the euro again. I'm using the hourly because you can see clearly, if you can follow it a little bit tonight, you can see clearly how the market will move instead of waiting for a couple of weeks to see if I'm correct or not. So first of all, you maximize the time frame and you see the historical bottoms, which is something like this. It's very easy. This is the average bottoms. If you want to mark the extremes also, you can put a line there. Normally I'm using borderline. All right, so in here, again, let's delete those lines. I'm not useful now. So, and then again, we see that on the last 3 days, which is the hourly time frame, so the market moved, came up to here, and I can see that now I'm reaching the extreme, the average extreme line on the rock, right? So then switching to the 10 minutes, waiting for the failure swing. I hope that you hear me now. Actually, it was deactivated sometime. I don't know why. All right. Okay. Again, we have positive divergence. So the rock is reaching the extremes. We are switching into the 10-minute chart. And then we buy the next failure swing. Most probably that was a little bit lower. So that means it's safer if you're waiting for the next failing to go lower and buy if we break higher, right? So, see again a little bit the drawing. So, in the case that you are on the 60 minutes chart and you are using this time frame, so you go on the 10 minutes. As soon as you make your checks, what are the checks? Trend, rock extreme below zero, and rock positive divergences. If I have all this stuff, then I go on the 10 minutes and I buy the first failure swing with 50% of my money. So then I'm waiting for the next failure swing on the 60 minutes, which is my original time frame, and I buy here the next 50%. If you are on the daily, then again you check that the market's going down. So then we go on the, let's suppose that this is my daily time frame, then the lower time frame is the 60 minutes, and then you go for the first failure swing on the 60 minutes, and then you add on the daily time frame. Let's suppose that you are on the weekly and you are taking positions for months. So then the lower time frame in this case is the daily. That means your time frame is a weekly and you go on the daily failure swing and then on the weekly failure swing to complete your position. This is my recommendation. And if we go a little bit again for a small revision, if you don't have questions. So we go again. First of all, we check the trend in our time frame. If I have two tops and two bottoms, after the B, we have the uptrend. The market finished this uptrend as soon as the rock 7 is going at the extremes, having a couple of divergences at least, or maybe 2, 3, or 4 of them. So, and then we short the next failure swing on our time frame. Let's suppose that this is the 60 minutes. So it's smart until you wait to see the failure swing on the 60 minutes to go on the 10 minutes and take the first failure swing on the 10 minutes that is almost at the E, right? So, and then you add on this time frame. So again, for the correct time frame, we are using the weekly and we go back 6 months. On the daily, go only 4 weeks and you check if there is a trend. Then for the hourly, we use 3 days. If you are using the stocks, then it's good if you see the hourly for the last 5 days if you have a trend. So again, the rock 7 is very simple oscillator, but it's pure momentum oscillator. We have negative divergence if the prices are still going up and the oscillator fails to follow actually the tops of the prices. So that means the oscillator shows lower tops and the prices are still going higher. This is the negative divergence, means that the prices will go to the failure swing for down. So, and then the positive divergence, if the prices are going down and the oscillator fails to confirm this one, it's a positive divergence. I'm telling you again that the divergences are very dangerous for short positions in this case. So why? Because we can continue to go higher and we still have divergences, unless you combine the divergences with the extremes of the rock cell. So the correct position size, as I told you, you can email us on the SmartLine, smartlineglobal.com. So, and we can send you this Excel file. Is very simple. So just to know your risk, actually. Again, I'm telling you, I recommend if you have 10 units, 10,000 units, margin it 30 times only. So you go for $300,000, and then it's a logical stop loss if you keep a 35 pips on the hourly, of course, 35 pips stop loss. Your potential profit always is 100 pips, which is going to represent the 30% of your money. So we can send this Excel file if you need it. So I don't know if there are questions. We have to cover it for the last 5 minutes, and then we can close the meeting. Okay, Mike. So you can.
Okay. Well, thank you very much. There is a question about where they can get the spreadsheet.
Yeah. Okay. So you can go on our site www.smartlineglobal.com, or you can email us on the info@smartlineglobal.com. All right. So I finished. Any more questions? Thanks, Mike. All right. So David.
Okay, thank you so very much. We really appreciate everybody joining us today for our webinar. Definitely go to smartlineglobal.com where you can get that information. And best of luck on all your investments. Join us again for our next education webinar coming up next week. Thanks, everyone.